Welcome to Daybreak Asia. We're counting down to Asia's major market opens.
The top stories this hour. A cautious mood in markets ahead of the Fed meeting as US inflation data does little to bolster bets on a pivot to rate cuts. China's annual economic work conference focusing on industrial policy is a disappointment for investors hoping for big-ticket stimulus. Plus, COP28 climate negotiators in last-minute talks over a new draft agreement calling for a swift transition away from fossil fuels.
We'll start you off with breaking news out of South Korea. We are getting the unemployment rate for the month of November coming in at 2.8%, which is higher than what economists had expected. It's also an uptick from the previous month of October, where it was at 2.5%. Still, suffice it to say is that it's still very low. Historically, it's still below the post-pandemic average of 3.3% for South Korea. And we know that 277,000 jobs were added in the month of November from a year earlier. Perhaps we have seen a little bit of a slowdown in the services sector, which was very much expected. Also, of course, manufacturing employment has been shrinking as of late. Again, the jobless rate in South Korea ticking up to 2.8%, Heidi.
Take a look at how Asian markets are setting up at this point in time. This is the picture as, of course, in the wake of those CPI numbers and whether or not we'll see much of an impact. We're seeing some caution as we get ahead of that Fed meeting, of course, a 60-hour window of fast and furious central bank decisions this week, the last of the year, right? And this is what we're seeing. We are looking at a pretty flat start to trading here in Sydney. At the moment, of course, we're watching the budget and whether the government can come through with any kind of targeted assistance for the cost of living crisis and whether more of that focus will go towards paying down debt. Not much of a move when it comes to yields here, when it comes to Australian and New Zealand bonds either. Broadly, though, we are seeing futures for Japanese equities looking a little bit higher there and watching currencies as well. 65.60s where we're trading for the Aussie dollar. Hong Kong futures looking pretty much unchanged at this point. Nikkei futures up by just about 0.1% there. Kiwi stocks are already trading underway about 0.4% higher, Sherry.
Heidi, take a look at how U.S. futures are coming online in the Asian session. We're seeing a little bit of upside and perhaps extending those gains that we saw in New York when the S&P 500 closed at the highest level since January 2022. Still, the moves were pretty small. Of course, we had the CPI numbers out today. That's out of the way, but we're headed towards the FOMC rate decision on Wednesday. But we are seeing really the VIX, the fear gauge, retreating towards that 4-year lowest. We're seeing more optimism in the markets. The Treasuries space was whipsawed today after the CPI report. The 2-year yield marginally higher, around 4.7%. Although the long-term yields actually fell given solid demand of an auction of 30-year bonds. And we're following oil prices at the moment rebounding a little bit after falling to the lowest level in 5 months. We continue to see signs of robust supplies. We have seen Russia's exports jumping to the highest level since early July as one of those signs. But it was really all to do with the U.S. CPI numbers, right? Consumer prices picking up in what looks to be a bumpy path down for inflation. To discuss, here's Bloomberg's U.S. economist Stuart Paul joining us now. Stuart, so break down the details of that data today.
So we saw core CPI increase from 0.2% in October to 0.3% in November. A big portion of that increase in the core was driven by shelter and an upside surprise in used auto inflation. So as you said, it does seem to be a bit of a bumpy path down in core inflation. The thing to keep in mind, though, is that the percentage of items within the core that experienced outright deflation during the month rose from 28% to 60%. So that disinflation impulse, that deflation is actually becoming a bit more pervasive. It is going to be a bumpy ride, but the increase and the upside surprise that we actually saw both in the headline and the increase in the core was driven by a pretty narrow subset of spending categories. So that disinflation impulse, that drag that's coming from primarily core goods is going to be something that Fed Chairman Jay Powell takes a lot of pride in and a lot of heart in.
So does this kind of highlight just the gap that we still see between, yes, getting inflation down from the year's high is obviously progress and one thing, but it's kind of an entirely different thing to get it to the Fed's target?
It is difficult to get to the Fed's 2% target. You see some policymakers, including Secretary of the Treasury Janet Yellen, that are very optimistic that it'll be a relatively slow but smooth path to the 2% target. We're a bit more pessimistic. We do see a bit of difficulty in trying to overcome some of the shelter inflation that's currently contributing to the core. Any tightness in the labor market further contributes to super core inflation. And if firms are successful in fully destocking their excess inventories, that drag that we're currently seeing from core goods prices might be set to reverse. So as Shery was saying, it's a bit of a bumpy path down to 2%. We expect that there is going to be a little bit more pain that the labor market has to experience if the Fed is going to achieve its goal of achieving that 2% average inflation target.
Bloomberg's US economist Stuart Paul there. Well, China's top leaders have vowed to make industrial policy their top economic priority next year. That's a message likely to disappoint investors hoping for more consumer-focused stimulus. Joining us now is Bloomberg's Greater China Senior Executive Editor, John Liu. John, it's interesting, obviously, because industrial policy has been one of the headline-making aspects of how Beijing continues to manage that, particularly vis-a-vis what we see with the US industrial policy. But investors would have been hoping for more fiscal support, for more pledges of broader economic support.
I think what we got from that statement out of the Economic Work Conference was really an expression of confidence that the economy is going in the right direction, the emphasis on continuing to upgrade the economy, growing the digital economy, upgrading manufacturing, talking about the property sector, not in the sense that there is an emergency and there's lots that the government is going to do to save the sector, but that the real estate developers should have their reasonable demands for financing met by the banking system. That is just reiterating things that the government has already done, and I think in that sense it will leave some people in markets disappointed. I think it's also interesting that on the second day of this two-day meeting, President Xi Jinping and a number of other top officials were arriving for a state visit in Vietnam, and so it does express in a different way a sense of confidence that Beijing knows what it's doing and is headed in the right direction.
Tell us a little bit about the Vietnam trip, because we heard that there were 30 plus agreements from those conversations. What are the highlights?
There was an agreement to invest to provide Chinese financing for a railway between the two countries. I think also important, there was an agreement for joint maritime patrols. Vietnam and China have had a rocky relationship. Part of that rockiness comes from competing claims in the South China Sea. The two countries fought a war in the late 1970s. So even though China is Vietnam's biggest trading partner, there is that underlying tension that's been added to by the fact that the United States has been courting Vietnam. We had Joe Biden visiting in September. Vietnam raising the level of its relationship with the U.S. to a comprehensive strategic partnership. It's the same setup that they have with China. And so in this visit, Xi Jinping trying to make sure that Vietnam does not move too close to Washington.
John, what are some of the domestic kind of challenges going into 2024 for presidency? Obviously, debt as well as the state of the economy is one thing, but it was interesting, I thought, that the tone that we've seen both from the Politburo readout as well as the Central Economic Work Conference seemed, almost sanguine. It certainly didn't express crisis levels, although I suppose they also wouldn't want to do that in order to try and maintain what semblance of confidence remains for markets.
So I think the leadership in Beijing learned a lot, or took a big lesson from the financial crisis of 2008, in that when China put out that 4 trillion yuan stimulus back in the great financial crisis, it solved a lot of problems, it buoyed the economy, but then it resulted in a lot of debt issues that the country is still dealing with now. And so there is, as a result, this real reticence to flood the economy with money, to pull out the bazooka, as it were. And I think that is what we are seeing. That is a more conservative approach to everything, even when dealing with the property sector, which I think is and will continue to be the biggest headache for Beijing heading into 2024.
Bloomberg's Greater China senior executive editor John Liu, and perhaps another challenge for Beijing now, a bipartisan group of U.S. lawmakers recommending higher tariffs on goods from China. They also want further restrictions on investments and called for revisiting of Washington's trade relations with Beijing. The recommendations underscore growing support for a more confrontational approach to China, even as President Biden seeks to ease tensions. Heidi.
And Shery, the United Nations General Assembly has voted overwhelmingly to demand a ceasefire in Gaza, underscoring a sharp shift in sentiment over Israel's war against Hamas. Let's get more from Bloomberg's Anna Edgerton. And, you know, we've seen these expressions of dissent before. The problem with the United Nations, of course, is that the US veto prevents it from going further.
Yeah, absolutely. And besides the United Nations, we've also seen individual companies and countries and groups of countries come out and say that it is time for a strategic ceasefire to allow some humanitarian aid into Gaza and to decrease the toll of civilian suffering that we see just about every day in that conflict. So, you know, part of the point of view from the international community is that this is not just, you know, against Israel's interests, but this is in the interest of a more secure Israel in the future, that in order to guarantee Israel a more safe and secure position in this region, they need to be conducting this military campaign differently.
Yeah, we heard from President Biden saying that top leaders like Jake Sullivan and Secretary Austin will be traveling to the Middle East this week, of course, as the conflict there continues. But of course, we've been watching that conflict in Ukraine as well, and those comments coming from that news conference. Tell us a little bit about what President Zelensky in his visit to Washington achieved.
Yeah, this was kind of an interesting confluence of those two stories because obviously the aid for Ukraine and Israel is caught up in this same request from the White House in Congress. So the White House has requested $106 billion in supplemental aid for Ukraine, Israel, the Indo-Pacific region, and the southern border. And right now, those negotiations have not progressed in a way that's seeing that package move forward. We're seeing more border demands from the Republicans in the House to secure the southern border of the United States, and it really depends on how that piece of this puzzle comes together, whether or not that additional aid for Israel and Ukraine is going to come out.
It kind of goes to the interesting topic of just how much bandwidth President Biden and the US leadership really have with these two hot wars ongoing, right? And I thought it was interesting, you know, perhaps President Biden earlier when he was speaking at that fundraising event about Netanyahu taking maybe a firmer stance on what he sees as the Israeli leader is needing to do in order to maintain not just American support, but certain global support for this war.
Absolutely. And I think, you know, Biden has said that he's always spoken very frankly with Netanyahu in private, and now we're seeing those tensions spill into public. And this is also a domestic politics issue for Biden. You know, he risks losing the support of a core constituency of his in the younger U.S. voters that are very concerned about the humanitarian toll in Gaza. So there's both kind of the geopolitical interest in making sure that both Ukraine and Israel have a secure future and a place in the international community, but also the domestic political interests for Biden and Democrats going into an election year next year.
Anna Edgerton there with the latest on foreign policy. And still ahead, we'll unpack the Chinese president's trip to Vietnam with dozens of new agreements signed in areas from trade and transport to joint maritime patrols. But up next, the market outlook with Navalier and Associates. Hear why they find the U.S. CPI report a bit disappointing. This is Bloomberg.
we are seeing inflation slowing, and it's consistent with what the Fed expects.
2%, is going to be the target, and I think they are on track to get there.
The last mile of the inflation journey is often the most difficult.
The Fed tomorrow is probably going to signal, yes, it's done, but don't expect rate cuts anytime soon.
The Fed is probably going to remain on hold at least until the third quarter of next year.
They should push back hard on cuts next year.
They're going to push back again against what the market is pricing.
The probability of a cut in March is almost non-existent, even June.
Getting a Fed that's cutting in May does feel like a bit of a stretch from where I sit right now.
The Fed probably will be higher for longer, and I'll actually be looking for Powell tomorrow to push back a little bit on where the market is, where it's gotten a little bit ahead of itself. I think this inflation report feeds into that narrative.
Bloomberg TV guest there on the latest U.S. inflation data, what it potentially means for the Fed. Does it change expectations now? Well, weighing in is Louis Navalier, who's the founder and chairman at Navalier and Associates. Louis, great to have you with us. Let me throw up for really the benefit of our viewers to take another look at those components of CPI and that report, and what was really, as you say, a bit of a disappointment for the markets in that it doesn't quite neatly fit into the trajectory of rate cuts, right? Core inflation remaining high in the U.S., up 4% year on year. That measure was at 6% just 12 months ago. So marginal progress, I guess, has been made. Energy prices have fallen, but services inflation, we know that remains stubbornly sticky. So, Louis, does this kind of tell us that, yes, we've made progress, we're off the year's highs, but it's still a long way potentially to go until we get to 2%? And is that what the Fed is going to be focused on?
Unfortunately, yes, and we'll get a better feel for it tomorrow with the dot plot. But I didn't like the fact that owner's equivalent rent was up 0.4% last month. It was up 0.3% the previous month. So that's been the kind of the sticking point why consumer inflation won't come down. Now, if you look at inflation on a 6-month window, it's wonderful, okay? And the Fed has sent out, Fed president saying, look how good it is in the last few months. So if they start talking about a 6-month window, yeah, we're already at the 2% annualized rate, but we're not. We have 0.4% inflation for the next 6 months that are going to be in the data until that gets cut off. So by June of next year, we will definitely be in the Fed's target range. So we're getting there. It's a little bit too slow.
How big a reckoning do you think the markets face given these pretty rapidly shifting expectations?
Well, because market rates have come down, I think we're fine. Okay. So far the Treasury auctions are going okay. The way the Treasury auctions work, usually the bills sell well, the notes sell well, and we'll see if they can sell the bonds. So we've had some glitches with the bond auctions, but so far so good. I think the market rates are actually more important. Again, if we look at inflation in a 6-month window, we're already there. We're in the Fed's target range. But it's the 12-month window is the problem. But every month for the next 6 months, they're going to cut off 0.4% from a trailing 12 months, and then finally we'll be there in June of next year.
What about the Bank of Japan? Obviously, this is a kind of other wild card in terms of dramatic pivots that we could see from central banks that could happen this month, I guess, if you speak to some investors, but certainly, within the next 6 months we're expecting.
Well, let's give the Bank of Japan credit. They let their bond yields rise, and they are a lot more significant than they used to be, at like 0.734 right now. And so that's how they've been trying to be strengthen the yen and all. They are the only central bank with negative rates, and they are not anticipated to change that policy. And one of the reasons probably why is we have deflation in China in the last 2 months. We even had deflation in Germany. So, Japan's a huge manufacturing economy, and a couple of their competitors are at falling prices now. So this is really not the window for them to uninvert their negative interest rate policy on the short end.
When you take a look outside of the US, what markets most excite you about 2024? Where do you see the most compelling opportunities?
Well, I certainly expect energy to reassert itself in February. You know, demand goes up in the northern hemisphere from seasonal pressure. I'm very, very worried that these attacks Russia is having could eventually hit their pipeline. You know, several days ago, their Trans-Siberian Railroad was hit twice to disrupt their trade with China, and obviously their natural gas pipelines are sabotaged. So I'm still worried about their big oil pipeline from the Arctic, that could be sabotaged. Ukraine's getting very desperate now. You know, obviously Zelensky's in Washington, D.C. now, and the U.S. is not ready to give him money because President Biden and our Congress are disagreeing on our spending priorities. So Zelensky's probably pretty frustrated right now.
Louis, really great to have you with us. Louis Navallier, founder and chairman at Navallier and Associates. Much more to come here on Daybreak Asia. This is Bloomberg.
You're watching Daybreak Asia. Argentina has devalued its currency, the peso, by over 50%. It's part of the first batch of shock measures by the new administration to revive the country's troubled economy. The IMF has already lauded the decision, saying it will help stabilize the economy and set the basis for more sustainable and private sector-led growth. Bloomberg's Buenos Aires bureau chief Patrick Gillespie joins us now. And Patrick, this was a pretty much expected move, but given how early it comes just after Javier Milei took office on Sunday, how significant is this?
Shery, this devaluation was really years in the making, considering the previous government had kept the official exchange rate overvalued for a very long time. And we were, the market had been expecting something in the order of 40 to 44% devaluation. And Economy Minister Luis Caputo, on his second full business day on the job, is devaluing the peso 54%. That is one of the sharpest devaluations since Argentina was in its hyperinflation in the early 1990s. So this is a sharp move, and Luis Caputo had a very somber message for Argentines and for markets that things have to get worse, especially with inflation in the near term, if anything is going to get better in the medium to long term. So we are expecting significant price hikes. We're already seeing some prices go up 25% overnight. So a very challenging real economy situation here on the ground as the government implements President Javier Milei's shock therapy program.
And it was the same messaging in the pretty somber inauguration speech too, right? He was warning that Argentinians would have to endure months of pain ahead. So what else do we expect in terms of the early changes in this administration?
What Caputo outlined a little bit more in detail tonight that Milei had not mentioned during his inauguration speech is exactly a little bit more surgically where they're going to cut spending, although he didn't say in each area how much of that they're going to cut. But he said a lot of for instance, a lot of spending the national government gives to provinces, that's going to be cut. Public work programs that haven't been started, those are going to be cut. If you got a government job in the past year, that contract is not going to be renewed. So that was among a litany, sort of a collage of measures on the fiscal side that Caputo outlined would help to eventually reel in a fiscal deficit. And on the currency side was this huge 54% devaluation. But Luis Caputo tonight focused his message as Argentina's new economic chief really on the fiscal side. And he said the country, in his words, has been an addict to fiscal deficits for much of its history. So he's really, as he said, trying to attack the root problem instead of going after the causes, such as high inflation and debt crises. So this is a really different message. Argentines are not used to this. The country often has fiscal deficits and goes after inflation problems. But this is a real big change of tone and policy direction.
Bloomberg's Patrick Gillespie there in Buenos Aires with that 54% devaluation of the peso. Coming up next, we get the latest on China and the latest pledges on diplomacy. This is Bloomberg.
You're watching Daybreak Asia. Chinese President Xi Jinping has pledged to prioritize diplomacy with Vietnam. State media say he told Vietnam's Communist Party chief that China hopes for a deeper partnership between the two nations. They signed 37 agreements, including on a cross-border railway and joint maritime patrols and a 3-year plan to boost trade. Xi's visit comes as Vietnam forges closer ties with the U.S. and its allies. For more, Huang Le-Tu, Deputy Asia Program Director at the Crisis Group, joins us now. Huang, great to have you with us. How successful would you say President Xi Jinping's visit to Vietnam was?
It's still going until today as well. So I think so far already quite a lot of achievement, as you mentioned. 30-something agreements was signed yesterday just after President Xi Jinping arrived in Hanoi. So the program is full, and a range of cooperation activities are going to be brought, from investment to even defense cooperation in joint patrol in the Gulf of Tonkin, which is quite an important step as well in cooperation. So I think by practical measures as well as symbolical, because this year marks the 15th anniversary of the comprehensive strategic partnership that the two countries have, it is going pretty well. President Xi Jinping received quite a fanfare welcome in Hanoi, hosted by Secretary General of Vietnamese Communist Party, Nguyen Phu Trọng, and he'll meet with other members of the leadership. So it is going pretty good from the media coverage. And I think it is an important visit, yes.
So how does it compare to President Biden's September trip, where they actually elevated the ties between the U.S. and Vietnam to a comprehensive strategic partnership?
So President Biden's visit was quite historical, given the trajectory of U.S.-Vietnam relations. And only this year did Vietnam and U.S. upgraded to the same level that Vietnam and China has had for 15 years. So it's a sort of different level of closeness. And there's certainly not that aspect of party-to-party relations, and even a party secretary general meeting another party secretary general sort of intimacy there. It's a little bit different in terms of the nature of the visit. I think both are important on their own merits and reflective of the specific sets of bilateral relationship. I think the President Biden's visit in September attract perhaps a little bit more attention globally because it was such a milestone given U.S. and Vietnam's relationship and its trajectory, whereas this one, it is quite important as well, but the two communist neighbors have had a quite close relationship for some time already.
How would you say Hanoi has been balancing the relationship with these two superpowers, which of course are engaged on geopolitical rivalry and tensions?
So given that Vietnam actually fought wars with both of those giants in the living memory, I would mark this as quite a successful foreign policy exercise, and Vietnam's actually giving a masterclass of its diplomacy, and which, you know, it's a post-conflict diplomacy with both giants. So I think Vietnam is learning lessons from the past, from the Cold War era, and from the past confrontations with both US and China, and learning that engaging with them, it bears better fruit than confronting them. So at the moment, especially that US and China are competing on many levels and different aspects, Vietnam is learning to benefit from some of the opportunities coming out from that competition, including, for example, some of the Western companies relocating out from China and searching for new markets and new hubs in the region, and Vietnam being next door to China and having conducive market and environment presents itself as a good relocation destination for some of these companies, including big techs. So in this regard, I think Vietnam is positioning itself well in the competition. And as you said, Vietnam has hosted both US president and now Xi Jinping. So it might be the only one that this year hosted both of them. So it's presenting itself pretty well, playing this great power competition.
China presenting itself to all of these different nations as a partner. We know President Xi Jinping, given President Biden's visit as well, has tried to re-strengthen that relationship with Vietnam. But at the same time, there's still thorns on the side of that relationship with Vietnam, given what's happening around the South China Sea.
Indeed, this is not an easy relationship. It is a relationship that is full of competition, confrontation, but also cooperation. And Vietnam is learning that. For Vietnam, this is the most important set of relationship. If it managed to have good relationship with China despite the dispute and despite the rising tension, then it really dictates all of others' foreign policy decisions and defense decisions for that matter. So it is very important that Vietnam navigates those security challenges, and on top of that also bears some benefits from economic, for example, opportunities. And for China, I think it is important to have a reassured neighbor next door. It considers Vietnam as a gateway to Southeast Asia, and also, you know, its direct periphery. So it's good for the big neighbor also to have good relationship with Vietnam, especially that it can benefit from that party-to-party affinity and common ideology. So this is something that certainly is highlighted during this visit because President Xi Jinping or Secretary General Xi Jinping is responding to the invitation of Secretary General Nguyen Phu Trong. So for that reason, I think China is also interested in Vietnam's good relationship, especially that Vietnam in recent years has become really a sweetheart of Western world. Not only the US is interested in upgrading relationship with Vietnam, but also most recently Japan and a number of major and middle powers from the Western world as well.
So Vietnam. It was really good to have you with us. We'll have to leave it there. Deputy Asia Program Director at the Crisis Group, Haidi.
Yeah, let's take a look at how broader Australian assets are trading at the moment. We are seeing some technical indicators that when it comes to equities, at least the ASX might be looking a little bit overheated. That index hitting the upper Bollinger Band, that 14-day RSI also approaching what we see as overbought territory. We are up, what, about 7% from that October trough. And if you take a look at these technicals, we might be nearing potentially a short-term pullback. So perhaps not a Santa Claus rally. We'll have to see about that. We're seeing pretty marginal gains so far in the session Also watching the Aussie dollar at 65.64. We had previously the dollar hitting that intraday low, as we had, for a lot of traders, a disappointment when it comes to that CPI print. Well, here in Australia, we're also watching the mid-year budget update. It shows that the government's books are in better shape than anticipated 6 months earlier, but that the outlook remains challenging. Joining us now is our economics reporter, Swati Pandey. So, the pretty significant improvement, what was driving that?
A large part of it is commodities prices that have been much better than the government's forecast. So government is always very conservative in its assumption of where iron ore and coal prices would be, and prices were pretty strong. The other reason is a very strong jobs market. We have unemployment rate hovering around 3.6, 3.7% over the past year, and so the tax receipt for the government has been pretty solid. So these have been the two major reasons. Obviously, they also benefited from strong migration. We had record immigration as well. So largely that has helped boost their books.
Swati, we're hearing from Treasurer Chalmers now saying that the budget is in, quote, striking distance of a surplus. So what's the outlook?
Look, we had an economist from Westpac saying that it will likely be a surplus. The government is just being ultra conservative in saying that it's still a small deficit, but it's pretty likely that we will see a second straight surplus. The outlook is challenging from here. They are facing higher interest payments on their debt because of higher yields and higher interest rates. And there's also this long-term pressure on the budget from an aging population, so on healthcare, as well as other welfare-related payments as well. So there are these long-term budget pressures which will keep the budget in deficit in the foreseeable future, and that's what the government is showing as well.
Are they different when it comes to what the RBA is seeing?
So in terms of their economic forecasts, the government is actually predicting a better employment, a worse employment profile than the RBA, but they are expecting inflation will fall back into the RBA's band earlier than the RBA is predicting. So in that sense, the Treasury's forecast look a little more optimistic than the RBA's forecast, and part of it could be because of their expectation around cutting spending and fiscal consolidation that the government has been constantly talking about. So the RBA will definitely welcome this because it shows that monetary policy and fiscal policy are aligned. But given that we have fiscal deficits in the year ahead, it shows that the government still needs to cut back on spending to really align with monetary policy.
Our economics reporter, Swati Pandey, there with the latest. And one stock that we're watching in the Sydney session certainly is Sigma Healthcare. Take a look at the surge that we're seeing in this stock. Of course, this is on the back of the Chemist Warehouse deal. This is off session lows, if you can believe it. It's up almost 41%. At one point, it had surged as much as 82%. That was most on record, unsurprisingly. The Sydney-listed healthcare company agreeing to merge with Chemist Warehouse, that is a big sort of pharmacy chain here in Australia, to create a wholesaler, distributor and retail pharmacy franchisor that would have an indicative market cap of more than 8.8 billion Australian dollars. Shares had been halted since the 6th of December, and upon that start of trading, clearly seeing that big jump. That proposal has Sigma acquiring Chemist Warehouse in exchange for shares and 700 million Aussie dollar cash consideration there. So continuing to watch that, but obviously coming off a little bit, but it was up by as much as 82%. Coming up next, climate negotiators continue to work on a draft agreement as COP28 draws to a close. We get an update and on how the withdrawal from fossil fuel usage might feature. This is Bloomberg.
Welcome back. The final day of the COP28 climate talks in Dubai ran into overtime over deep divisions about fossil fuels. The first draft of a deal designed to bridge that gap had been criticized as too weak by some nations. Bloomberg's Sue Keenan joins us now with more on this. And Sue, of course, we have continued to see really the divergence in opinions in those discussions. Are we nearing a final text at this point?
Yeah, it looked like everything went down to the wire. There were meetings until the early morning, Wednesday hours in Dubai. And the last-minute negotiations were fed by optimism on the part of some participants who felt these deep divisions, mainly on finance and future of fossil fuels. The key areas that brought criticism from participants, mainly the U.S. and EU, as being too weak in the first draft. They felt if they went through further negotiation, they could get to a point of agreement. A new draft that's been viewed by Bloomberg News has much stronger language on the swift transition away from fossil fuels. There was a view that if Saudi Arabia, which has been strongly opposed to any kind of fossil fuel cuts, and other fuel-dependent nations, if they could agree, that would seal the deal. And diplomats, as I said, were running between bilateral meetings and huddled over revisions well into the morning hours. U.S. Senator Kerry has said that the new text on this so-called outcome document is stronger on fossil fuels and that, quote, progress is moving in the right direction. We do know the compromise text represents a more forceful assertion of the world's commitment to cutting greenhouse gases while steering clear of polarizing promises to phase out fossil fuels, which really irritated these fuel-dependent nations, including the Saudis. So the so-called outcome document, we understand, has been finally drafted. There has been no formal putting forth of this document as of yet, but we're continuing to monitor the progress.
Meanwhile, we're seeing oil futures steadying a bit in the Asian session, but still under quite a bit of pressure.
Yeah, definitely in the New York session, we saw WTI plunge almost 4% to below 69. As you mentioned, coming back a bit in Asia trading, but this is part of a steady decline we've been seeing, and it's all because there's continued concern about rising supply from non-OPEC members like the U.S. and now Russia, and all of this is creating a concern about a global oil glut. Russia's seaborne crude exports rose on a 4-week average basis, and that is due to a big jump in weekly flows after those storms that we talked about that disrupted the Black Sea shipments. Well, that storm is finally over. Loading soared at one key Russian port with nonstop activity all week. And if you look at the Bloomberg there, WTI prices have already been on a 7-week decline. That's the longest losing streak since 2008, and now under pressure again going into this week. One oil veteran notes futures are trying to solidify and find a bottom from last week's sell-off. He says the contango structure of back-month futures gaining on front-month, settling the tone, are really signaling that current supplies seem more than ample. Back to you.
Bloomberg Sue Keenan there. I'll take a look at some of the other climate-related stories that we're tracking today. U.S. government data shows power generated from solar and wind systems will surpass burning coal next year for the first time. Coal is seen producing 70 billion fewer kilowatt hours as more utilities shutter aging power plants. Meanwhile, developers are expected to install 23 gigawatts of solar capacity this year, plus 37 gigawatts more next year, making it the fastest-growing source of new generation. The Arctic saw its warmest summer on record this year. A new Arctic report card shows the region experienced an average temperature of 6.4 degrees. That's half a degree higher than the previous record set in 2016. The report also highlights polar climate trends, including shrinking sea ice and warmer surface temperatures. In November, the UN declared 2023 as the hottest year on record. Well, coming up, ad revenue for the social media platform X is projected to slump this year. We get the details on that. Bloomberg Scoop is next. This is Bloomberg.
We have breaking news out of Japan. We are getting the fourth quarter Tankan survey with the large manufacturer sentiment index coming in at 12, which is beating economists' expectations and also an improvement from the previous number at 9 in the previous quarter. When it comes to the non-manufacturing sector, we are seeing that the index has also improved more than expected to 30 from 27 in the previous quarter. When it comes to the outlook on spending by these big manufacturers, it's also coming in the double digits of growth of 13.5% for this fiscal year, really showcasing better sentiment ahead of the BOJ meeting next week. When it comes to the small manufacturers, it's also really risen into expansionary territory. One is for the fourth quarter, coming from a contraction of -5 in the previous quarter. So all in all, sentiment seems to be improving across Japan corporations, and we're seeing that their inflation outlook for the year is coming in at 2.4% year-on-year as well when it comes to these manufacturers' expectations for price pressures in the coming year, Heidi.
Let's turn to a Bloomberg scoop for now. We've learned that Elon Musk's social media platform X is on track to bring in roughly $2.5 billion in advertising revenue this year, and that marks a significant slump from prior years. Let's get some more details from our technology reporter, Kurt Wagner there, who joins us in San Francisco. And Kurt, we've heard, Elon pretty colourfully address his woes when it comes to advertisers, and it seems like the numbers that we've seen would support that.
Yeah, I mean, this is a reflection of how people feel really about Elon and his behavior, right? It wasn't that long ago that he was on stage, dropping expletives at advertisers, calling their decision to blackmail, to boycott Twitter, the equivalent of blackmail, right? And so, I think that this is a theme that is not new. It's something we've really seen since he took over late last year. And, I think these numbers sort of reflect the fact that a lot of advertisers are uncomfortable with spending money at a place where the owner is pretty unpredictable in this way.
We have seen X's strategy also veer into other parts of the business. So how important is advertising at this point, and how will that change in the future?
Yeah, so advertising at X and previously Twitter was always the majority of the revenue, right? It used to be 90% of revenue. It's now, I'm told, between about 70 and 75%, so it's becoming a little bit less important. But part of that is also just because they're not making as much advertising revenue now. The company would like to move away from this dependence. They're trying to get into subscriptions. They're trying to get into more data licensing. And part of the reason is that they don't want to be so dependent on these advertisers who do, get sensitive when the CEO comes out and says certain things, right? And so I think they figure subscriptions in particular, if that could be a really big business for them, that would take a little pressure off of the advertising side. As we've seen, though, that just has not materialized in the way that Elon had hoped that it would.
Our technology reporter Kurt Wagner there joining us from San Francisco on X. And these are some of the other stories in the tech industry that we're following. Apple is adding a feature to iPhones to prevent thieves from gaining access to critical device data in the event that they know a user's passcode. A beta test version features an enhancement which requires Face or Touch ID to access settings, including payment information. It's unknown when the new feature may roll out to all customers. Netflix has released viewer data for every title on its platform for the first time. The release covers more than 18,000 films and shows that generated between 50,000 and 100,000 hours of viewing time. The most detailed disclosure ever for any streaming service follows the months-long fight between Hollywood labor unions and major studios. ASML and Samsung Electronics will jointly spend $760 million to build a South Korean plant to develop cutting-edge semiconductor processing technology. The Dutch company says the facility will use its next-generation extreme ultraviolet equipment technology. The deal expands ASML's presence in Korea, where it already has 4 sites serving customers, including Samsung. South Korea has unveiled a 5-year, $29 billion financial package aimed at helping local electric vehicle battery makers diversify supply chains. The finance ministry says Yoon Suk-yeol's administration wants to boost the Korean battery industry from mining to recycling. The move comes as the U.S. calls for reduced reliance on Chinese-made batteries. Coming up, we'll be talking about the broader markets with Julius Baer. This is Bloomberg. This is Daybreak Asia. We're counting down to Asia's major market opens after we saw U.S. stocks rising. The moves were very small, given that we are very much focused on the upcoming FOMC decision, Heidi. We have U.S. CPI out of the way. We saw prices picking up, which really shows that the ride down for inflation will be pretty bumpy.
Yeah, and not particularly a straight kind of trajectory, right? And I suppose the question now is really focusing on how it potentially changes the tone of communication from Chair Powell, from the FOMC, as we see really the gap between, yes, it's not 6%, but it's certainly not 2%, and there's still some way to go, isn't there?
And that in itself will make a lot of difference for how Japanese assets, especially the yen, trades, right? Because we continue to see this huge rate differential with the BOJ keeping its monetary policy ultra loose. Take a look at the yen right now at that 145.30 level. We're seeing a little bit of strength on the yen. This, of course, after we saw option traders really positioning for stronger currency headed into the BOJ decision. And as we head towards that decision next week, we already saw large manufacturers in Japan, their sentiment in the Tankan survey improving. We saw that rise to 12 from an estimated 10 and 9 in the previous quarter. When it comes to big manufacturers positioning for the Japanese yen, they actually expect it to be stronger at that 138.30 level this fiscal year. We're seeing the Nikkei now gaining 0.4% for a third consecutive session of gains. Take a look at the Kospi because we had gained ground in the previous session. We're now coming online down about 0.25% for the Kospi and the Kosdaq. This, of course, as we are now seeing the Korean won also holding steady, perhaps a little bit of strength, given that we're seeing the dollar marginally down after the CPI numbers, and we are seeing the won at 13.12. But South Korea, of course, we got the job market report as well, and we saw that the November adjusted jobless rate actually rose to 2.8%, really higher than economists had expected, Heidi, but still below the post-pandemic average of 3.3%.
Shery, take a look at how we're trading when it comes to Australian assets, and there are some signs, if you take a look at some of the technicals perhaps, that we are headed for possibly a bit of a near-term pullback for the ASX. If you take a look at the Bollinger Band and the 14-day RSI, it does look like perhaps there's a bit of overheating there for the ASX. We're up about, 7% from the index's troughs of October, so potentially that puts the Santa Claus rally in doubt, right? The index hitting the upper Bollinger Band. and approaching overbought territory if you take a look at the 14-day RSI at the moment. But we are seeing one outperformer, and that's really Sigma on the back of this Chemist Warehouse deal. It rose by over 80% at one point, certainly a stunning outperformer on what is otherwise a pretty muted session here in Sydney. Not a great deal of moves when it comes to the Aussie dollar either. 65.65 is still where we're trading at the moment after a session where the dollar, the greenback, that is hit an intraday low with the sort of muted response to November core CPI numbers as well. And we are also watching for that sort of mid-year budget update from the government, which is expected to show that the Australian budget is looking healthier, more robust than expected, but the outlook remains challenging. This is a picture when it comes to treasuries, and the question is really whether we see this kind of repricing, the reckoning when it comes to the bond market from an adjustment of inflation and Fed expectations, right? We did see treasuries springing to a gain after pretty solid demand at the 30-year auction. We've seen some pretty lackluster demand for the auctions over the past couple of days or so, but we saw that yield of about 4.3 for that 30-year. So long end treasury demand certainly seeing a bit of a re-ignition there ahead of still some uncertainty in terms of what we expect from the Fed and from Chair Powell.
Heidi, let's bring in our next guest, who says most investors were not positioned for the fireworks of November, and nor are they fully positioned for a good year in 2024. With us now is Mark Matthews, head of Asia Research at Julius Baer. Mark, always great to have you with us. Is the idea that we're going to have a good 2024 predicated on the fact that 2024 will be the year of the pivot, whether it's the Federal Reserve, ECB, or BOE?
Partially, Shery, I think so, and we believe the ECB will be the first to move among the major central banks in March. We don't expect the Fed to cut until September, but that's okay. I think that we've seen this year the markets have been surprisingly adept at handling these high interest rates, and I don't think that'll change if the leadership remains in the big technology stocks, which we expect it to do.
What are the chances of disappointment? Because it seems markets are pricing in for a lot of easing next year, with the first rate cut to come in May.
Well, if they're expecting a rate cut in May, I think they will be disappointed, because you'd have to see a significant deceleration in the economy for that to happen. But I have a feeling they'll take it in stride. And as I said, the generative AI and the massive investment we can see that these big tech companies have been doing in data storage capacity to accommodate this impending revolution, I think will mean that the revenues and profits of these big technology companies will remain extremely strong. And as you know, they're a significant part of the S&P. So just to use NVIDIA as an example, I'm obviously choosing the best one, but their PE this year, which is 60 times, will be 25 times next year. And they've got an ROE of 70%. I don't see how you can call that expensive.
But because of those gains from the tech sector and the Magnificent Seven, we have seen that breadth has been lacking across the S&P 500, right? Is that concerning when it comes to potential gains next year?
Well, we've started to see this month a bit of a broadening in the market to those other companies, but I don't think so. If you look back in history, narrow breadth, I know it sounds intuitively like narrow breadth should be some kind of negative indicator, but historically it has not been a predictor of poor future returns. So I admit breadth has been very constrained to these big tech companies. Maybe it broadens a little bit, but we believe they're going to continue to be the leaders until they don't have a good story anymore. But I think they're going to have a very good story, at least for the next year.
Mark, what about China? Will we see a good story there? I mean, we had the World Economic Conference, and we have seen more pledges to do more for the economy from Beijing policymakers, but at the same time, it doesn't seem to be clearly targeted towards demand-stimulating measures.
Well, China is the proverbial story of the boy who cried wolf, but in that story, in that fable, eventually a wolf did come to the village and eat all the sheep. So eventually the Chinese market will bottom, and I think it should be very close. The Hang Seng Index is the worst performing stock market in the world this year. It's down about 20% this year. And this will be the fourth year in a row that it's had a negative return, which in its history that goes back 60 years has never happened before. So if you just sort of adopt the dogs of the Dow strategy of buying the highest dividend companies, and by the way, the Hang Seng now has a dividend yield of 4% and a PE of 9. I suspect that it's going to do well next year. I mean, I think it's going to be in a band because of all the things that have happened in China, not unlike the band that it traded in between 2010 2015. But we're right at the very bottom of the band now, and I think it could easily rally 20% and then stick around in this band.
Mark, what's the band when it comes to the Japanese yen? There has been so much volatility. We are now hearing from the Tankan survey from the BOJ that large manufacturers are positioning for a 138.30 yen this fiscal year. Are we going to see more strengthening of the currency, and what would that mean for the broader stock market?
If the currency strengthened, intuitively, that should be negative for the Nikkei. If you just look at the inverse directional correlation those two have historically had. But we don't think the yen is going to strengthen. We think 145 is fair value based on the BOJ only raising rates once over the next year. So we think they raise once to 0 and then they don't do any more. Ueda himself said last week that the wage negotiations next March will be absolutely crucial to his policy decisions. And you can see the wages in the most recent numbers have been softening in nominal terms and in real terms, and so is household consumption, so has GDP. So I think what's happening is that the Japanese economy is starting to soften, and that will be an excellent excuse for the Bank of Japan to remain very dovish.
Mark Matthews, head of Asia Research at Julius Baer. Good to have you with us with his views in the broader markets. As we're seeing breaking news out of Argentina continue, we're hearing that Argentina will be targeting a 2% peso devaluation per month. Of course, earlier today, we had heard that strategy coming from the economy minister that Argentina was planning to devalue their currency by 54%. They also had announced a series of spending cuts as the first steps of President Javier Milei's sort of shock therapy program in order to boost the economy. We know that the Argentinian government is now planning to cut Social Security and pensions by 0.4% of GDP. They will also cut transport subsidies to save 0.2 percentage points of GDP. And we're also expecting the Central Bank of Argentina to make monetary policy announcements on Wednesday. So we'll be looking forward to that. In the meantime, we had heard that the administration had weakened the official exchange rate to 800 pesos per dollar. We're now hearing that they will be targeting a 2% devaluation per month, Heidi.
Shery, certainly, a pretty big move, but perhaps one that was not at all sort of unflagged going into this administration taking over, right? Take a look at some of the movers that we're following so far when it comes to the trading session in Seoul. We are seeing Korean entertainment is moving on some Netflix user data that we're seeing, the likes of Dexter Studio, Showbox there, some of the big movers to the downside. 1.9% lower is what we're seeing for Content Tree, and SBI Holdings there, one of the biggest laggards there as well, down by just about 3% in the early part of the session. Some of these K-drama production-related stocks are seeing a bit of a decline after Netflix releasing viewer data, which actually showed the popularity of Korean content on the platform. In fact, Studio Dragon's The Glory Season 1 was the third most popular series on Netflix in the first half of the year, but we're not seeing a great deal of positive reaction other than for Dexter Studios. We are also watching SBI there. SBI Securities suspected of manipulating stock prices, according to a report in the Nikkei. And we're seeing SBI Holdings there down by just about 2.8% there. The Nikkei reporting that Japan Securities and Exchange Surveillance Commission is considering recommending that administrative action be taken against SBI Holdings, the brokerage. Well, still ahead on Daybreak, China's putting its homemade passenger jet on display outside the mainland for the first time. It's seeking to win customers from Boeing and Airbus. We get analysis coming up in the next hour on the Comac C919. But first, Australia's budget now within striking distance of a surplus for the second year. Details of the mid-year update, including some of those latest inflation forecasts next. This is Bloomberg.
China's top leaders have vowed to make industrial policy their top economic priority next year. That's a message likely to disappoint investors hoping for more consumer-focused stimulus. Joining us now is Bloomberg's Greater China Senior Executive Editor John Liu. John, so what sort of support are we expecting from the government?
So the readout that we got from this economic work conference was one that portrayed the leadership as seeing the economy as, yes, there are challenges, there are problems, but the economy overall is portrayed is doing okay. There's progress being made. And they're going to take the opportunity now to work on upgrading the industrial infrastructure, structural issues, building for tomorrow. And I think also good to point out that trying to make China's supply chains more resilient. Obviously, there are the ongoing tensions with the United States and Europe. But I think that will be disappointing for any market participant whose vision of the economy right now is one that's in a lot of trouble and one that needs help immediately. And so that, I think, is where the disappointment will come in.
What did we get from the messaging and the tone from the senior leadership, John? Because, you know, what one sort of analyst said, it sounded almost sanguine, right? Are they just trying to strike a confident tone as to not cause a further deterioration of market sentiment?
So I think there's two things. I think on one hand, whatever the leadership is thinking in private, we don't know, but in public they are trying to portray a sense of confidence in the economy. They are trying to portray looking forward into the future that the economy has turned the corner already. Second, I think is there is more of an emphasis, I think, in this current administration on security issues of diplomacy than there has been in the past, and especially vis-a-vis the economy. I think we've seen that in the data security issues that have come to fore, some of the issues with national security as well. And so I think that is coming into play in this messaging as well.
Yeah, on that geopolitical focus, of course, we have President Xi Jinping in Vietnam with more than 30 plus agreements or so. What are we getting from that relationship?
I think that is a very good point. So the second day of this two-day conference, President Xi Jinping and a lot of senior leaders were there in Vietnam, arriving for the first state visit since 2017. Important to point out that this visit comes after Joe Biden visited in September. The two countries, Vietnam and China, have a very rocky relationship. China is Vietnam's biggest trading partner, so economically very vibrant, a lot of trade happening. But at the same time, there are disputes about the South China Sea. These two countries fought a war back in the late 1970s, and so there is an ongoing sense of mistrust and suspicion there. And with Vietnam getting closer to the United States, I think this is an example of Beijing not wanting Vietnam to get too close to the United States.
Bloomberg's greatest China senior executive editor John Liu there in Hong Kong. Well, here in Australia, the mid-year budget update has shown the government's books are in better shape than anticipated 6 months earlier, but that the outlook remains challenging. Joining us now is Bloomberg's Paul Allen, and a lot of this has to do with commodities prices.
It does. The planets have really lined up for the government on this. Commodity prices have been strong. That's a trend that we've seen continue since May, and they're forecast to keep on being strong. The iron ore price forecast in this update, $60 per tonne, still very conservative, but the government always errs on the side of caution when forecasting that. But tax receipts have been strong as well, from companies, from individuals as well, so plenty of money around. The question is what do you spend it on without fueling inflation? And the answer in this case is getting rid of debts. And as we foreshadowed before this announcement, interest on debt, now the fastest growing pressure on the budget bottom line, more so than the National Disability Insurance Scheme. But in terms of growth, we've got a new set of forecasts. GDP seen troughing at 1.75% this year. Unemployment seen peaking at 4.5% in 2025. And CPI, crucially, getting back to the RBA's target range, 2.75% in June 2025.
Paul, the Treasury seemed to be pretty optimistic about a potential surplus being in striking distance. What's the outlook?
The outlook is also pretty good, forecasting a narrow deficit in May next year of 1.1 billion Australian dollars, although it wouldn't be a huge surprise if we did see a surplus in May, and there could be an element of politics at play here. The government may be unwilling to forecast a surplus because that would raise all sorts of questions about, well, you've got all this money, what are you doing about cost of living relief? But that deficit, much smaller than the 13.9 billion deficit forecast back in May. So 2 surpluses in a row, certainly within the realms of possibility. But again, in terms of cost of living, how do you address that without fueling inflation? Well, one possibility could be relief on energy bills, some more discounts there. We've seen that before. And there is a little bit of spending here, $5 billion on housing supply, $3 billion on critical minerals and clean energy development. But the spending very much deliberately on the conservative side.
Bloomberg's Paul Allen there with the latest on Australia's budget. And you can get a roundup of all of these stories that you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Day-B-Go, also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get the news on the industries and the assets that you care about. This is Bloomberg.
The United Nations General Assembly has voted overwhelmingly to demand a ceasefire in Gaza, underscoring a sharp shift in sentiment over Israel's war against Hamas. Let's get more from Bloomberg's Michael Heath, and we've seen individual nations also calling for a strategic ceasefire. We've also seen President Biden, a little bit sharper in terms of pressing Netanyahu to come back to the two-state solution as well. So a lot of pressure on Israel.
Yeah, I mean, there's sort of two different things in a sense, because the General Assembly, I think it reflects the, as you mentioned, the growing concern in the world that the civilian casualties, basically society's almost breaking down or has broken down within the Gaza Strip. I mean, it's a real reflection of that. Australia, New Zealand, Canada. I mean, Australia's a strong supporter of Israel, but all these places are now supporting a call for a ceasefire, which obviously isn't going to happen as long as the US is fully supporting Israel, which Biden reiterated when in his recent remarks on Netanyahu. But it is interesting because the what happens after this war is a really serious question, and Netanyahu is very wily, very wily. He raised the Oslo Accords, from 1993, which was probably the closest the world's ever come to resolving this issue. If you remember, the US, after the first Iraq War, pressed Israel and forced it and the Palestinians to come up with a peace plan, which eventually broke down in violence. But Biden is basically determined that this is on the agenda. This is part of the issue. He understands where Netanyahu is coming from, because Netanyahu is leading the most right-wing government probably in Israeli history. But I think he's also giving Netanyahu a bit of an out, in the sense that he says that that right-wing government gives him little room to manoeuvre. Netanyahu for 30 years has basically opposed all of this stuff. So it's going to be fascinating to watch. As to the situation in Gaza now, I mean, catastrophic, disastrous. The UN General Assembly, I think, basically reflected that in its vote, with people either abstaining or voting in support of a ceasefire. So the pressure will only grow, and Biden said that as well to Israel, that there's only so much he can do to keep that, particularly in Europe, from people starting to join the chorus for a ceasefire.
Michael, we heard that top U.S. officials will be headed to the Middle East again this week. How much pressure can feasibly come from the U.S. on Israel to be more mindful of civilian casualties?
Yeah, Shery, it's a really interesting question, because on one hand you'd say they can exert enormous pressure. I mean, the US is supplying munitions, it provides financial support to Israel. Its carrier groups off the coast of Israel deter Iran and these other countries from potentially widening the conflict. So it's central. On the other hand, because there's such strong public support for Israel in many parts of the US, it's almost constrained in what it can do with Israel, because it can't go too hard on it, because it has to risk the domestic backlash there. So it is interesting, but I think that what they're going to try to do to Netanyahu and to the government is to sort of convey that there's only, the US is powerful, the US can veto UN resolutions, etc. But at the end of the day, the US can't sort of stand up against the whole world if Israel keeps acting, to some extent indiscriminately, was mentioned as well by the US in terms of these bombing campaigns. I mean, these are words that they're worrying. They have to worry the Israeli administration.
What's also worrying President Biden, obviously, the Ukrainians, is the failure to secure more aid, right? This is just tied up in the mess when it comes to border reforms and immigration reforms. Does it kind of indicate the stretched bandwidth of the US at the moment? It
does, but the one thing with Zelensky is he's the Ukrainian president. He's an incredibly charming guy, and some of the reports we got out of his meetings with the Republicans was that they were very inspired by him, but they're determined to keep it linked to this border immigration solution. And I think one will be found, because for the US political class, losing Ukraine would be like losing China in 49. It would just be catastrophic. So they will fix it.
Bloomberg's Michael Heath there. More to come here in Daybreak Asia. This is Bloomberg.
Take a look at how markets across Asia are trading at the moment. We're seeing the Nikkei now gaining ground for a third consecutive session. We have tech, utilities leading those gains, although the energy sector is weighing on the index, given, of course, the losses that we saw in the previous session in New York, where oil fell to the lowest in 5 months. We're also digesting the Tankan survey, showing that sentiment among large manufacturers has improved. The Kospi is also reversing those gains that we saw in the previous session. We had the jobless rate rising to 2.8% from around 2.5% in the previous month. It's still really a low rate given the post-pandemic average of more than 3%. The ASX 200 seeing gains with Australia's budget update showing the government's books are in better shape than had been expected. And of course, we're headed towards trading in China. Sources telling Bloomberg that Country Garden is likely to avoid its first default on yuan bonds after most holders of a local note agreed not to demand repayment this week. For more, let's bring in Bloomberg's bond and loan reporter Loretta Chen in Hong Kong. Loretta, so what's the onshore bond in question right now, and what kind of credit protection did it give creditors?
Yeah, that's right. So this result that Country Garden managed to avoid a default onshore was really hard fought by both the company and the regulator in China. So there are 2 yuan bonds that Country Garden faced interest payment, but more importantly, they also have an early redemption option for the investors. So since last week, the Shenzhen Exchange has been talking to holders of one of the notes, which has a CDS, a credit default swap, plus an early redemption option, trying to convince them not to ask for early repayment of the bond. And so this week we learned that none of the investors proceeded with that early redemption requirement, which helped the company to essentially manage to avoid an onshore default.
How significant would it be for Country Garden to avoid a default?
Yeah, I think importantly we have to distinguish, for these developers what happens with their onshore debt versus their offshore debt. So Country Garden has already defaulted on the offshore dollar bond in October, and since then it has been, trying to avoid such a scenario happen onshore because the result or the consequences of that happening would be catastrophic to its buyer confidence onshore and also to the wider property market. So I think that result is widely expected because we have seen in the past that Chinese developers have been prioritizing onshore investors over foreign investors. This is yet another example of how foreign investors are left with a prolonged multi-year process of restructuring while the onshore investors manage to dodge that such default scenario and manage to avoid bearing huge losses.
Bloomberg's bond and loan reporter Loretta Chen there in Hong Kong. Let's get your preview of the market open in the mainland and Hong Kong. China's top leaders are vowing to make industrial policy their top economic priority this year. Our Asia Equities reporter Charlotte Yang is in Hong Kong. Charlotte, we keep looking for catalysts to lift sentiment, right? Just how low confidence is when it comes to, in particular, mainland equities and offshore as well. They're probably not going to get it from the Central Economic Work Report. Conference report.
Yeah, so for equity investors, there is no major surprise from the Central World Economic Conference. There's a clear message that the policy is going to 2024 that is going to be pro-growth, but that is basically confirming the message and the signals we got from the Politburo meeting last week. So market has really fully digested that, and also investors are now have to wait longer in terms of to figure out how the government is trying to support the property sector as well as what kind of fiscal measures we'll be expecting next, because on the property, there's nothing really new there, even though the government has omitted that line, property is not for stimulation, housing is for living, but that is not enough to show investors the way forward. But with that said, we're likely to see some specific actions on the specific sectors, for example, new energy vehicles, as well as, consumer electronics as China, and also with AI, as the government has made it a clear prioritization of industrial policies, as well as some specific sectors they highlighted to boost consumption next year. So I think equity investors are expecting more product-based, product-specific consumption support measures instead of some broad swapping package at this stage.
Charlotte, are investors more optimistic, at least when it comes to the longer-term outlook of the Chinese stock market, especially as we head towards 2024, given the losses that we already saw in 2023? I mean, the CSI 300 has seen declines of more than 10% at this point.
Yeah, I think at this stage, there's not really that confidence, even though with, like you have mentioned, with all, this year how market has underperformed, and there is really the valuation story is very intact because, into 2024, there's still people are still waiting the domestic economy recovery, and with, this meeting, which we didn't get much clues on in terms of what kind of, if there will be any big fiscal package to support that. And I think it's very important to remember, how the regional setup is so different because, Japan, India, everyone's so bullish here. The economic outlook is so strong there versus China into 2024. There's still a lot of uncertainties in China.
Asia Equities reporter Charlotte Yang there with what to expect from the Chinese stock markets. And China's financial policymakers are in Hong Kong this week, seeking to bolster the city's status as a hub for investments, deals, and also talent. Sources tell us that officials from the Ministry of Finance are meeting with bankers on Wednesday. Among those invited are HSBC, Standard Chartered, and Bank of China. The discussions will center on how to enhance Hong Kong's position as an international finance center while strengthening ties with the mainland. Still ahead, China's homegrown commercial passenger jet is making its first trip outside the mainland, set to go on display in Hong Kong. More next on China's chances of competing with Boeing and Airbus. This is Bloomberg. You're watching Daybreak Asia. China set to show off its homemade Comac passenger jets with a display in Hong Kong on their first trip outside the mainland. Joining us now from the Hong Kong International Airport is our Asia transport reporter, Danny Lee. Danny, so tell us a little bit about this jet and the likelihood of it competing with jets from the likes of Boeing and Airbus.
Yeah, it's a really exciting day here at Hong Kong International Airport. Chinese plane maker Comac has brought its two passenger jets to Hong Kong, the C919 and the RJ21. But all the attention will be inevitably on the C919. It's the first time in particular that the C919 has left the Chinese mainland, and it's got a big stage, the Asian financial hub, to actually show off what it can do with this particular jet. And obviously, because it doesn't have any foreign buyers, only Chinese airlines and lessors, and so therefore, trying to drum up sales and drum up attention. This is its big moment here in Hong Kong, and officials from the city and the airport will be celebrating its welcome. Arrived yesterday, and so we'll be also getting a tour inside the plane just to see what it's all like.
So, Danny, you talked about the sort of uphill battle for the Comac in international markets, right? What are the ambitions for China here?
Yeah, I mean, for particularly using the C919 jet, it's their design. China wants it to rival Airbus and Boeing with its A320 and 737 aircraft. And these are the two most profitable sets of aircraft for both Boeing and Airbus. And China, being a huge aviation market and is set to be the world's biggest in the years to come, Comac has an opportunity to really set its agenda and also to drum up a lot of sales from a potential market, not just in China, but globally as well. But it's still yet to find its feet. It's only been able to deliver 3 commercial jets so far in a year. And so therefore, its ambitions is really going to be tied to how many aircraft it can produce, but also just how many sales it can drum up. It's got a backlog at the moment in excess of 1,200 jets. It's managed to secure a recent top-up order of 100 jets at a tune of $10 billion from China Eastern. But really, its success will be whether it can really go global. And that's still yet to be seen, because even right now with its commercial jets that are flying, they're only flying for 5 hours a day. And so therefore, it still has a lot of work to prove what it can do and how capable it is. But here in Hong Kong, it's got the opportunity to do just that.
Bloomberg's Asia transport reporter Danny Lee there in Hong Kong. Let's bring in with some more analysis David Yu, who's a chairman at Asia Aviation Valuation Advisors. David, great to have you with us. And so I think I'll go back to kind of what I was alluding to with my question to Danny just before. What are the ambitions for this plane maker, and what's the anticipated market, I guess, looking beyond just the Chinese airlines?
Well, thank you for the question. And basically, the ambition is to have this aircraft be a global competitor to the Boeing and Airbus narrow-body aircraft. Of course, it's starting out from Chinese mainland, and now it's coming to Hong Kong, and hopefully it will go to many more countries. But first things first, they have to develop and make sure that the aircraft is certified by EASA and FAA, which is recognized by many countries around the world. At the current moment, it's certified by CAAC, and so that is definitely one part to get over. But many places in Southeast Asia, as well as Africa, at least as a starting point, friendly countries to China, and good relations there to start things off.
How successful do you anticipate that is going to be?
It's going to take. It's definitely going to take some time. If you look at any new market entrant in this space, and the most prominent one is actually Airbus itself, it's taken a while for the aircraft and its products to be accepted by the world stage. And before then, they was going against Boeing, who was really the lone player at that point. So they're going to have some time to get developed and make sure and prove that the aircraft itself is operationally what it stand out to be, and at the end of the day, be profitable for the airlines that operate them.
Is COMAC seeking FAA certification? And if so, how challenging would that process be?
It's definitely in talks with doing so, and that process, given the current situation, geopolitical situation with the U.S., would create some hurdles in that respect. So in the meantime, the plane is being run and tested, and hopefully get more traction, both from the domestic operators, the big three, but also some other folks in the region, in the Asia region first.
How much demand is there, and could that be an opportunity for China, right? You say that there's been a lag in supply from OEMs. Does that mean that if we could see faster ramp up, that there is that opportunity there?
Definitely. At the current moment, there is a slow order production by the other two major OEMs. And there is a lack of aircraft, both brand new as well as used, out here. And airlines want to come back and grow and replace their existing their fleet. So if COMAC can step it up and increase their production, this would be a great time to sell some new aircraft, as well as place them in places that I think otherwise will be take longer to get traction. So it will be a great time if they can take advantage of it.
David, really great to have you with us. David Yu, Chairman of Asia Aviation Valuation Advisors. And super interesting, right, Shery, whether we could see kind of market opportunity for this COMAC plane, given just how much appetite there remains for aircraft and travel.
Yeah, we'll continue to see really how much of a rebound we can see in Asia. We have talked about the tourism rebound in Asia really lagging everywhere else in the world post-COVID. But take a look at these other Other corporate stories that we're following right now, Apple adding a feature to iPhones to prevent thieves from gaining access to critical device data in the event that they know a user's passcode. A beta test version features an enhancement which requires Face or Touch ID to access settings, including payment information. It's unknown when the new feature may roll out to all customers. Netflix has released viewer data for every title on its platform for the first time. The release covers more than 18,000 films and shows that generated between 50,000 and 100,000 hours of viewing time. The most detailed disclosure ever for any streaming service follows the months-long fight between Hollywood labor unions and major studios. ASML and Samsung Electronics will jointly spend $760 million to build a South Korean plant to develop cutting-edge semiconductor processing technology. The Dutch company says the facility will use its next-generation extreme ultraviolet equipment technology. The deal expands ASML's presence in Korea, where it already has 4 sites serving customers, including Samsung. Bloomberg has learned that Goldman Sachs executive Ed Emerson is stepping down. Emerson oversaw the resurgence of the commodities trading business after pre-pandemic slump. Sources say he's one of the highest paid executives at Goldman Sachs, earning roughly $100 million over the past 3 years. That's even more than CEO David Solomon, whom Emerson has criticized over strategic missteps. We'll have more to come on Daybreak Asia. This is Bloomberg. Heidi, for a long time, we've talked about this buildup in the world economy. And of course, with borrowing costs now at this level across the world and with the higher for longer narrative as well, we are now seeing the world's poorest countries struggle under $3.5 trillion in debt. We're talking about 2024, these nations known as rich world investors as frontier markets will have to repay about $200 billion in bonds and other loans. And the bonds issued by my home country of Bolivia, not to mention Ethiopia, Tunisia, and a dozen other countries are either already in default or trading at levels that suggest investors are bracing for them to miss payments.
Yeah, this is really, after a decade of borrowing, now it's the time for the catch-up, right, for the world's poorest nations. As you mentioned, about $200 billion in bonds and other loans issued by Bolivia, Ethiopia, Tunisia, about a dozen other countries there. So the situation is, particularly dire, I guess, Shery, because these nations have small domestic markets. They're not particularly liquid. They must turn to global lenders for cash to spend for infrastructure, for hospitals and roads, and things that they want to build, right? And we also know this comes at a time when China's economy is slowing in a way that it never has before. China used to be really almost the financier of first resort when it comes to a lot of these emerging smaller frontier nations, the build out of, big infrastructure proposals and marquee projects like Belt and Road, for example. The AIIB was really such a big component of that. We know that landscape when it comes to, debt diplomacy has really changed as well.
And of course, with a slowdown in the Chinese economy and really unexpected, perhaps, slowdown in the U.S. economy, even a potential recession, those smaller economies are expected to suffer the most with, of course, those ongoing financing concerns. And of course, also a topic where there's been big divisions between the global south and other more advanced economies has been when it comes to climate change. The final day of of the COP28 climate discussions in Dubai ran into overtime due to deep divisions about fossil fuels. The first draft of a deal designed to bridge that gap had been criticized as too weak by some nations. Bloomberg's Sue Keenan joins us now with more on this. And Sue, what's the latest?
Well, in the end, you had 200 countries that were deadlocked, and this new draft had to be worked on. Final discussions really caused disagreement because the last-minute negotiations, again, were fed by a bit of confidence that they could somehow still bridge division on finance and the future of fossil fuels. These are the key areas that brought criticism from participants like the U.S., the U.K., the EU, and those countries most vulnerable to extreme climate change. And the language at issue was key. Phase out, phase down, or a different formulation when it comes to really starting to get rid of the use of oil, gas, and coal. A new draft that was viewed by Bloomberg News has much stronger language on the swift transition away from fossil fuels. That's more of the language that's now being used. And there was a view that if Saudi Arabia, which has strongly opposed any fossil fuel cuts, and other fuel-dependent nations could agree, that would really seal the deal here. We know that diplomats were running between bilateral meetings and huddled over revisions into early Wednesday morning. There's still no final outcome document, as it's called, that's been released. But again, U.S. Senator Kerry and others who have looked at the new text on this document say it's stronger on fossil fuels and that, quote, progress is moving in the right direction.
Oil futures are steadying a bit in the Asian session, but still quite a bit of pressure that we saw.
Yeah, this was a big drop in the U.S. session, down almost 4%. So we saw West Texas Intermediate close below 69. And this is part of a steady downturn that we have seen out of concern of oversupply, not only from the U.S., which has upped its output, but also from Russia. The latest statistics showing that on a 4-week average basis, there's a lot more oil coming out of Russia. A lot of this has to do with the jump in weekly flows after storms that had disrupted shipments out of the Black Sea. Those storms have come to an end, and loading just soared at one of the key Russian ports. If you drop it in the Bloomberg, the West Texas Intermediate prices have already been on a 7-week decline. So we're already looking at the longest losing streak since 2018. Now there's been additional pressure this week. One veteran oil analyst notes that futures are trying to solidify and find a bottom from last week's sell-off. He says that the contango structure we're seeing of the back month futures that are now gaining on front months is setting the tone that current supplies seem ample. Other key gauges that a lot of traders and analysts follow, such as time spreads, those are also signaling oversupply. And as you can see in those charts, the near-term trend continues to be lower.
Bloomberg Sue Keenan there. Well, the latest climate stories that we're following at the moment, and US government data showing that power generated from solar and wind systems will surpass burning coal next year. For the first time, coal is seen producing 70 billion fewer kilowatt hours as more utilities shutter aging power plants. Meanwhile, developers are expected to install 23 gigawatts of solar capacity this year, plus 37 gigawatts more next year, making it the fastest growing source of new generation. The Arctic saw its warmest summer on record this year. A new report showing that the region experienced an average temperature of 6.4 degrees, half a degree higher than the previous record in 2016. It also highlights polar climate trends, including shrinking sea ice and warmer surface temperatures. In November, the UN declared 2023 the hottest year on record. Still to come, we get a closer look at China's economic and market outlooks. Officials vowing to prioritise industrial policy.